In this video, we are going to start working on question 24 of chapter 3. Fox Corporation acquired all of Greenberger's company's outstanding stock on January 1st, 2016 for $600,000 cash. So this $600,000 cash is the total considerations transferred from parent company to the subsidiary company. Greenberger's accounting record showed net asset on that date of $470,000. So this $470,000 is the total book value acquired by the parent company. So parent company paid $600,000 and acquired $470,000 book value. Although equipment with a 10-year remaining life was undervalued on record by $90,000. So equipment is the account that have different fair value from book value, and the difference is $90,000. And any remaining excess amount will be allocated to goodwill. So that's a goodwill and considered to have indefinite life, which means that we do not amortize goodwill. Greenberger reported net income in 2016 of $90,000, $100,000 in 2017. The subsidiary declared a dividend of $20,000 in each of these 2 years. Account balance for the year ending December 31st, 2018 follow. Credit balances are indicated by parentheses. Okay, so acquisition happened at the beginning of 2016, and the account balance in the following tables are for the end of 2018, which means that's kind of 3 years past. Okay, and then we are going to use the following videos to show you how to solve this question. Okay, so let's start with step 1, the allocation schedule of subsidiary acquisition date fair value. So in this schedule, we first need to know what is the total considerations paid. This question, Fox Corporation, the parent company, in total paid $600,000 cash for the acquisition. And next, the total book value acquired of the book value of the subsidiary company is $470,000. So both numbers are given directly by the question. And then next, let's see what is the excess amount of consideration over book value. So the excess amount is $130,000. It equals to $600,000 minus $470,000. And then we need to allocate the excess amount to those accounts, to those subsidiary companies' account that have a different fair value than book value. Okay. Allocation of excess to accounts. And it is the information is given that the subsidiary company has the equipment which is undervalued by $90,000. So the allocation amount is the undervalued amount, that is positive $90,000. Equal to the fair value minus book value. Because it's undervalued, then it's going to have a positive $90,000. Well, that's the only account that has the fair value from book value, and then we need to allocate the remaining amount to goodwill. So here goodwill equals to the total excess amount minus the account that is undervalued, 90,000. So we have 40,000 left. It's positive number, and it goes to goodwill. Okay, and because now we have a capital asset that is undervalued, and then we need to prepare the annual excess amortization schedule as well. And I'm going to combine these two schedules into one. And I'm going to work on that directly here. So that is going to be the equipment. So for equipment, it has the remaining life of 10 years. And assume that we are using straight line method to depreciate the equipment, which means that the annual amortization amount for the equipment would be $9,000. And as for the goodwill, because we assume that goodwill has the indefinite life, which means that we do not amortize it directly. So the total annual amortization would be 9,000 just for the equipment. Okay, so that's the that's all for the step one. In step one, we figured out what is the balance of goodwill, also figure out what's going to be the annual amortization that we need to adjust for every year for 10 years. Okay, so now let's have a look at the questions. Question A. Determine the December 31st, 2018 consolidated balance for each of the following accounts. The first one, depreciation expense. So depreciation expense would be the depreciation expense in the book, and plus the excess annual depreciation expense we just calculated over here, plus 9,000 equals to 659,000. The second one, dividends declared. And dividend declared will be only the dividend paid by or declared by the parent company. And as to the subsidiary dividend, they are eliminated. They are eliminated because that's inter-entity transfer, and we are going to use consolidation entry D to eliminate this 20,000. Okay, so the consolidated total will be 120,000. Next one, revenues. And the revenue will be the total of their reported revenue, equal to 1.4 million. And then equipment. So here on the book, the net amount of their equipment is 900,000 plus 600,000. But remember, equipment is undervalued, so and it's undervalued by here by 9,000. So we need to plus 90,000. That is 19,000. And also we need to consider the 3-year annual amortization. That is from the beginning of 2016 to the end of 2018. So we minus 3 times 9,000. Okay, so the net amount of the consolidated equipment is going to be 1,563,000. Next one, buildings. So the buildings is going to be the total of their current book value, that equals to 1.2 million. And next one is the goodwill, and so we know that goodwill is 40,000. If there's no impairment, then it's going to be the same. Do I have goodwill here? Nope. So goodwill should equals to 40,000. And next one is common stock. And remember that we will use entry S to eliminate Greenberger's equity account, which means that we do not consider Greenberger's equity balance. So the consolidated total of the common stock should be 900,000. Okay, so that is the answer for question A. Question B. How does the parent choice of an accounting method for its investment affect the balances computed in requirement A? Parent choice of accounting method for investment would have no impact on the consolidated total. Okay, that's the answer for question B. No impact. And question C. Which method of accounting for this subsidiary is the parent actually using for internal reporting purpose? And for this question, the answer is initial value method. And so I'm going to use question D to explain why we can say that it's using initial value method. Question D. If the parent company had used a different method of accounting for this investment, how could that method be identified? So the way we identify which method the parent company is using, we can look at their investment income balance. So investment income is actually what is the income from the subsidiary company. So here is the income from Greenberger. If the parent company is using initial value method as what we have here, then its investment income equals to the dividends declared and paid by the subsidiary company. Okay, so that's why we can say it's using initial value method. However, if the parent company Fox is using equity method, then the investment income would equal to the reported net income by the subsidiary company and adjust for the annual amortization. That will equal to 100,000 minus the 9,000. That will be 91,000. That's going to be the balance of investment income. And if the parent company using partial equity method, then the investment income would equal to the reported unadjusted net income of Greenberger. That is exactly 100,000. So that's how we identify which method the parent company is using. Okay, and I'm going to use next video to give you the answer for question E, the last problem. All right, let's have a look at the last question. What would be Fox's balance for retained earnings as of January 1st, 2018, if Hello? Alright, so now let's look at the last question. What would be Fox's balance for retained earnings as of January 1st of 2018 if each of the following methods had been in use? Okay, so right now we know that Fox is using initial value method, so the balance is given, and then we need to figure out what's going to be the beginning balance of their retained earnings in 2018. Okay, so there could be different ways to solve it, and here let me just show you my method. And so what I'm going to do is that because we don't know what's the beginning balance of retained earnings in 2016, let's assume that value is X. So I use X to represent the beginning balance on the acquisition date of the retained earnings. And then each period, the retained earnings is going to be the parent company return earnings is going to increase by its own net income plus the income from the subsidiary company. That is the balance over here, investment income. So this investment income from subsidiary company drives the difference among these three different methods, right? Because right now the parent company using initial value method, and then the investment income equals to the dividend declared by the subsidiary company. However, if Fox using partial equity method, then investment income would equal to the reported income by Greenberg 100,000. So that's $80,000 difference. While if Fox using equity method, then the investment income will be adjusted net income by Greenberger. That will be 100,000 minus the excess annual amortization. That's also okay. So that's another different number. Okay, so then let's come back to this three different methods, and because the own income earned by Fox are the same across these three different methods, then we can consider that information irrelevant, is not going to impact our calculation. So let's just focus on where the difference comes from. So, alright, so we assume the beginning balance of the return earnings of the parent company is X, and then during 2018, and let's just focus on what's the investment income report included in the parent's book. So if the company using initial value method, then the investment income would be the dividend paid or declared by the subsidiary company, that is 20,000 plus 20,000. Well, if the parent company using partial equity method, then the investment income would be 90,000. Well, if the parent company using equity method, then the net income reported or included in the parent company return earnings would be the reported net income and then minus the excess annual amortization. So this is adjusted net income from the subsidiary company. Alright, so that's in 2016, and in 2017 we can do similar things. If the right now the Fox using initial value method, then the investment income is 20,000. Thus, Greenberger declared the same amount of dividend each year, so that's 20,000. While in 2017, the reported income from Greenberger is 100,000. That will be the investment income with partial equity method, 100,000. And then if the parent company using equity method, then the investment income should equal to 100,000 and minus the annual excess amortization. Alright, and then after 2 years operation, the beginning balance, the ending balance of their return earnings, or the beginning balance of return earnings at 2018. Right now, the Fox is using initial value method, and the balance is given, right? 1.1 million. If the current balance, so that's 1.1 million. But we don't know anything about the, we are looking for the balance here and here. Is that solvable? The answer is yes, because we can use this equation to help us to get x, which means that x plus 20,000 plus another 20,000 should equal to 1.1 million. So in this equation, we have one unknown variable, and we can solve it. So x should equal to 1,060,000. Well, even though I assume this is the beginning balance of the retained earnings at in 2016, but this is not the actual amount because I also ignored the parent company's their own reported income during these 3 years. So this number is larger, but it's not going to impact our results because the parent company's their own income is irrelevant. So I just ignore that part. Alright, so if we know that x equals to 1,060,000, and we plug in x into the for the other two methods, then we can solve it and get that annual balance for the for the equity method would be 1,232,000 and 1,250,000. Okay, so that's how I solve this question. And the difference among these three numbers are driven by how much investment income is recorded on the parent company's book.